What if the biggest mistake in dividend investing is not buying the wrong stock, but buying the right-looking stock for the wrong reason? Most beginners see a 6%, 7%, or even 8% dividend yield and assume they are building a reliable passive income stream. But yield is only the surface. The real engine behind long-term dividend investing is free cash flow, dividend growth, payout discipline, valuation, and the moat protecting future cash generation. Because sometimes a high yield is not a gift. Sometimes it is a warning signal. The stock price collapses, the payout ratio stretches, growth disappears, and eventually, the dividend gets cut. Today, we will break down the biggest dividend investing mistakes beginners make, using real examples: SCHD, Johnson & Johnson, Realty Income, and AT&T. Because the goal is not building a portfolio that looks rich today. The goal is building one that survives for decades. Mistake number one is chasing dividend yield without understanding dividend quality. Let's compare four income vehicles. SCHD is not an individual company. It is a dividend growth ETF. Its yield sits near 3.35%. But the real advantage is not extreme yield. It is diversified exposure to high-quality dividend businesses at low cost. Johnson & Johnson represents something different, a classic dividend king. Its yield is lower, around 2.38%. Many beginners ignore it because the income looks modest. But experienced investors study the moat, the balance sheet, healthcare resilience, and decades of dividend growth. Realty Income requires another type of analysis. Because it is a right, traditional earnings metrics can become distorted. That is why serious REIT investors focus on AFO, occupancy, debt costs, and capital access. AT&T is the warning example. The yield still attracts many investors, but its 5-year dividend growth rate turned negative after the dividend reset. And that changes everything, because compounding requires rising income, not simply high income today. The beginner asks, how much does it yield? The serious investor asks, can this income grow safely for the next 10, 20, or 30 years? Mistake number two is underestimating dividend growth. A 5% yield with no growth may look superior to a 2.5% yield growing at 7% annually. But over time, dividend growth changes everything. This is where yield on cost becomes powerful. Imagine an investor buying a stock yielding 3% today. Now imagine that dividend growing steadily for the next 20 years. The market price may fluctuate constantly, but the original cost basis remains fixed, and the income stream keeps expanding. That is the essence of dividend growth investing. Not simply passive income. Expanding passive income. This is why Dividend Aristocrats and Dividend Kings matter. These are companies that survived recessions, inflation cycles, interest rate shocks, bear markets, and competitive pressure, while continuing to raise dividends. But the title alone is not enough. A dividend king can become overvalued. A dividend aristocrat can experience slowing growth. An ETF can underperform, and a REIT can face refinancing pressure. That is why serious investors combine historical performance with current fundamentals. Free cash flow, payout ratio, debt maturity, earnings quality, and valuation. Dividend investing is not passive during the research stage. It only becomes passive after the portfolio is built with discipline. Now consider a long-term dividend income projection. Assume an investor builds a diversified dividend growth portfolio yielding 3.5% today. Now assume that income grows at 6% annually. After 10 years, the yield on cost could rise to approximately 6.3%. After 20 years, and it could exceed 11%. That does not require speculation. It requires durable businesses, reasonable payout ratios, reinvestment discipline, and time. This is why serious investors avoid building portfolios around today's highest yield. A weak high-yield portfolio may produce more income in year 1, but less reliability by year 5. A stronger portfolio usually blends categories. Dividend growth ETFs like SCHD provide diversification and low-cost exposure. Dividend kings like Johnson & Johnson provide stability and long-term dividend history. REITs like Realty Income provide higher current income, but require AFO-based analysis. Turnaround income names like AT&T require additional caution because the dividend history includes a reset. The objective is not maximum yield. The objective is maximum sustainable income growth adjusted for risk. Because real portfolios are not built to impress on spreadsheets, they are built to survive real markets. Now the danger zone. The first risk is valuation. Even the best Dividend Aristocrats can become poor investments when purchased at excessive multiples. The second risk is payout quality. A payout ratio based only on accounting earnings can mislead investors, especially with REITs. For Realty Income, AFFO is far more useful than simple EPS because depreciation distorts real estate earnings. Its 2025 dividends represented roughly 75% of diluted AFFO per share. The third risk is the dividend trap. AT&T is a clear reminder that a famous company and a large yield do not guarantee long-term dividend growth. Its 5-year dividend growth rate remains negative, and that makes it very different from a true compounding dividend growth stock. The fourth risk is ignoring free cash flow. Dividends are not paid from slogans. They are paid from cash. If free cash flow weakens, debt rises, or management prioritizes balance sheet repair, the dividend can become vulnerable. The fifth risk is overconcentration. Many beginners buy 5 high-yield stocks and assume they are diversified. But if all 5 depend on the same interest rate cycle, the same credit market, or the same consumer weakness, the income stream is not diversified. It is correlated. Real dividend investing is not about collecting tickers. It is about underwriting cash flows. The most expensive beginner mistake is believing dividend investing is simple because dividends appear predictable. But the dividend is only the final result. Behind every dividend are margins, debt, free cash flow, capital allocation, competitive advantage, and management discipline. A strong dividend portfolio is not built by chasing the highest yield. It is built through payout safety, dividend growth, reasonable valuation, durable moats, and time. So here's the question for serious investors. Would you rather own a 7% yield that never grows or a 3% yield that compounds for decades? Leave your answer in the comments and include the ticker you believe best represents true dividend growth investing today.